1.54 million. That's how many Australian mortgage holders were classified as being at risk of mortgage stress in May 2026, according to Roy Morgan. Official arrears are still low, and that is the number the RBA, the banks, the financial TV, keep pointing to. But arrears are a late signal. Mortgage stress shows up much earlier. It shows up when the household budget gets rebuilt around one line item, the bank repayment. Right now, 29% of Australian mortgage holders are classified as at risk, and more than 1 million of them are classified by Roy Morgan as extremely at risk, meaning even interest-only repayments would take up an unsustainable share of income. That matters because low defaults can create a false sense of stability. Households can keep the mortgage current for a long time by cutting everything else first. Savings get drawn down, then credit cards get used. Family support fills the gap. Discretionary spending disappears, so the mortgage stays current while the rest of the economy absorbs the damage. That is a stress official arrears data does not capture. Today we're going to walk through the repayments maths now rivaling the late 1980s, the fixed rate promise that did not hold, the stress that arrears data misses, the rise of mortgage prisoners, and where all this sits inside the 18-year cycle. Let's get started with the maths. KPMG's latest analysis based on ABS data through the June 2026 quarter shows the household interest repayment burden has officially climbed to 5.4% of income once consumer debt is included. Home loan interest alone is running near 5%. For context, in 1989 and 1990, when the cash rate hit 17.5%, the interest to income peak was around 5.7%. So Australia has not passed the 1989 peak yet, but it's extremely close. And analysts expect the burden to move towards 6% if the RBA hikes again. That distinction matters. We're not beyond 1989, but we're rivaling it. The only clear worst period in the last 40 years was during the GFC, when Gen X households saw the burden hit 7.9%. But the comparison is still severe. Australia is approaching the repayment pressure of a 17.5% cash rate era, while the cash rate today is only at 4.35%. The reason seems to be pretty simple. The loans are obviously much bigger. The average new home loan reached $735,000 in March 2026. That means a smaller move in interest rates now produces a much larger dollar impact, and we haven't seen wages go up all that much compared to where they were 30 to 40 years ago. Take a $750,000 loan. At 2%, the monthly repayment is roughly $2,800. At 6.5%, it's about $4,700. That's roughly $1,900 to $2,000 every month extra in the same household. And incomes obviously have not kept up. Real per capita household disposable income is down a record 8% since mid-2022. As KPMG's Terry Rawnsley put it, paying off a home used to be a source of security. Now it's increasingly becoming a source of anxiety, and who knows what's going to happen over the next 5 to 10 years, whether we're going to see those same sort of gains as we've come to expect. This is not a clean crash. It seems to be a grind. And that slow grind may not always show up as sharp fall in the headline price. Part of the correction can happen through inflation. A house can sit at the same nominal price for years and still lose value in real terms. Hear that. Hear that again. Make sure that sinks in. If a home was worth $1 million 3 years ago and it's still worth $1 million today, the owner may feel like nothing has changed. We've seen that before too. But if the cost of everything else has risen over that same period, then the same $1 million does not buy what it used to buy 5, 10 years ago. The number on the property app looks stable. We're not seeing those crashes as an example. The purchasing power behind that number has fallen. As I said, we've seen that before as well. That is how property downturn can move quietly, not through a dramatic crash on the screen, but through years where prices stop rising while inflation does the damage in the background. Now let's take a look at the fixed rate story. Most people heard about the fixed rate cliff, around 880,000 loans worth about $350 billion rolled off cheap fixed rates. But that cliff mostly happened in 2023 and 2024. The issue in 2026 is the aftershock. Some borrowers who locked in 1.9 to 2.5% fixed rates in 2021 and 2022 are now moving straight into variable rates above 6%. The expectation was that rates would be lower by the time those loans expired, or at very worst, stable. Hold on long enough and the maths should improve. But that's not what has happened. The RBA delivered 3 cuts in 2025, then reversed course with 3 hikes in early 2026, taking the cash rate back to 4.35%. For borrowers who were waiting for the relief, the exit narrowed instead of opening. You can see the stress in the behavior. Google searches for fixed rate loans spiked more than 250% in March 2026. Banks are also leaning on one of the few tools left, longer loan terms. Around 430,000 Australian mortgage holders extended their loan term in the first half of 2025 to cope with the repayments. That essentially would bring down your monthly repayment by extending the loan. Just having that till death mortgage for an extra length of time. Lenders including Pepper Money, Great Southern Bank and RACQ are now offering 40-year mortgages. We talked about this with the 18-year cycle back 5 years ago. This is what they were going to do. Stretch a $600,000 loan from 30 years to 40 years and the monthly repayment can fall by about $300. But the trade-off is severe. The borrower can add up to $350,000 in total interest over the life of the loan. That's not a solution to affordability. It is a way to make the monthly number look survivable. The debt does not disappear. It gets pushed further into the future. We've heard this before, kicking the can down the road. And the reason rate relief has not arrived is inflation. Underlying inflation was still 3.6% in May. Headline inflation sat at 4%. Both were above the RBA's 2 to 3% target range. Here are the banks. This is what they're saying. Westpac is now forecasting 2 more hikes in August and September, which would push the cash rate towards 4.85%. So the same institution borrowers hoped would ease pressure is now being forced to keep pressure on. That brings us back to the question, if the strain is this clear, why are official arrears still calm? The answer is that defaults usually need a second trigger. The RBA has its own framework for this, the double trigger. For a wave of defaults, households usually need to do 2 things at the same time. They need to be unable to repay, and they need to be in negative equity. Until recently, rising property values and a still functioning labour market masked the stress. If a borrower still has equity, they have options. They can refinance, they can sell, they can draw on savings, they can restructure, they can delay the pain. So the absence of a default does not mean the absence of stress. It can mean the borrower is still finding ways to keep the loan current. Remember, tops take time. They're a process, especially in real estate, which is such a long trending cycle. Equifax describes part of this behavior as optimizing existing debt. Households refinance, they cut spending, they move debt around, and redesign their finances around repayments. That stress does not always show up in the arrears column, at least not yet, but other signals are already moving. Confirming mortgage arrears rose to 1.36% in the first quarter of 2026. That still sounds low, but the increase was nearly 3 times the typical seasonal rise. Non-conforming arrears hit 5.32%. The human side is also becoming harder to ignore. The National Debt Helpline received nearly 14,000 calls in April of this year, up from 11,500 the year before. Digital Finance Analytics has identified postcodes where 100% of mortgage holding households are now spending more than they earn. These are Campbelltown, Mount Druitt, Berwick, Daisy Hill. These are not default stories yet, but we can see the data. They are cash flow stories. And cash flow stress is usually hit with the rest of the economy before it hits the mortgage books. People cut groceries before they miss a mortgage repayment. They cancel holidays. They stop eating out, or at least I hope they do to meet some of these repayments. They delay purchases. They empty savings, which is the sad part. The house stays current, everything else gets cut. That lines up with what we're already seeing. GDP per person went backwards in 9 of the 11 quarters heading into 2026. Consumer confidence sat at 68.5 in March, with only 15% of Australians saying they felt better, basically better off than a year earlier. Now let's take a look at the borrowers with the fewest options, the mortgage prisoners. This is where policy becomes part of the trap. APRA runs a serviceability buffer. In plain English, when a borrower applies to refinance, the bank has to test whether they could handle repayments at 3 percentage points above the actual rate. That buffer remains at 3%. So APRA has held it there through 2026 despite political pressure to lower it. Now consider the position of a typical stretched borrower. They have made every repayment. They are paying a high rate with their current lender. They try to refinance to a cheaper deal, but they fail the stress test on the better loan. So They can't move, they're stuck. They remain stuck with the more expensive lender. That's how a borrower with a clean repayment history can still become trapped. If this has happened to you, let me know in the comments section. It'll be interesting to see how many people this is actually happening to right now at this stage of the cycle. An MFAA broker survey found 68% of brokers identified the buffer as the #1 reason clients could not refinance. And credit conditions are tightening further. From February 1st, 2026, banks can issue no more than 20% of new loans to borrowers with a debt-to-income ratio above 6 times. That's not going to cut the deal, is it? That removes more credit from the system. At the same moment, many households need flexibility. New loan commitments already fell 6.2% in the March quarter. The most exposed group is recent first home buyers. The government screwed them again, especially those who bought through the government's 5% deposit scheme. That's where I was going to double up with that. The government screwed them again. Many of these are sitting at 95% loan to value with almost no equity buffer if prices soften. And in some cases, like Sydney and Melbourne, they have been softening. The affordability collapse shows how thin the margin has become. Only 14% of median income households can afford a median priced home in 2026. 3 years earlier, that figure was 43%. That is a major deterioration in buying power. And the buyers with the smallest deposits are the most exposed. Investors are also being squeezed. They're facing higher rates on one side and smaller tax shelter on the other. In 2026, federal budget changed the rules. From July 2027, investors buying established properties after budget night will no longer be able to offset rental losses against wage income. Negative gearing on existing homes will be removed. Around 1.3 million Australians currently rely on that concession. That matters because investors often act as the buyer of last resort when prices soften. But if rates are higher and the tax benefit is weaker, that support becomes less reliable. Rates go up, tax benefits go down, credit gets tighter, affordability gets weaker. Basically, that's the setup towards the peak of the cycle every single time. So audit your own exposure before the system forces you into the decision. Now, place all of this inside the real estate cycle. Real estate tends to move in rough 18-year rhythm. That's 14 years up. We get to a peak and then a decline into the bottom. Fred Harrison and Phil Anderson trace this pattern through more than 200 years of land data through the UK and the US. The late stage of the cycle has a name. It's called the winner's curse. This is the phase where the last buyers pay the highest price with the thinnest deposits at the least forgiving point of the cycle. And the behavior we just walked through fits that pattern. Credit has been stretched to its limits. 40-year mortgages are being used to improve serviceability on paper. DTI caps are being tightened because leverage is already high. 95% of loan schemes brought thin deposit buyers into the market near the top. This happened 20 years ago as well. Affordability has collapsed and refinancing has become harder. That is what late cycle credit stress looks like. And again, that does not mean every suburb has to print a dramatic nominal fall. Some of the decline can be hidden in real terms. Flat prices in an inflationary economy are not true stability. They are a slow loss of purchasing power. And we should all be aware of that by now with things like the dollar getting inflated away. The framework says land prices lead and credit contraction follows. That is a sequence now taking shape. That is what a late cycle pressure point looks like. To be clear, this does not mean everything will collapse tomorrow. Market tops are usually a process. They're not a single event. The stress moves through the system one borrower cohort at a time. Some households are fine, others are stretched but are managing, and the weakest group usually breaks first, basically that weakest link. Obviously, I'm not your financial advisor, but these situations do have practical implications. If you're a homeowner and your repayments are manageable, do not assume rate falls quickly just because headlines say relief is coming. Run the numbers at a higher cash rate scenario. If you are stretched, especially with a thin buffer or a recent purchase near the top, build liquidity and stress test your budget against, say, 4.8% or 5% just to be protected, not at today's rate. If you're sitting on capital and waiting to buy, patience matters. Late cycle markets can tempt people into forcing the trade too early. Buying at the wrong point can mean spending years waiting just to get back to break even. Now, playing devil's advocate, I could also be too cautious. The cycle could take longer than expected. Policy could shift, but I'd rather be early on risk management than late. So now I want to hear from you guys. How does this resolve? Does the RBA eventually cut to relieve mortgage pressure even with inflation still above target? Or does inflation force them to hold higher for longer until the weakest borrowers start to break? Drop your calls in the comment section. I'll be reading through them as I reply to as many as I possibly can. See you guys at the next video or over on my other channel where I cover stocks, commodities, Bitcoin, and the real estate